The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. On today's episode, we're going to be interviewing another partner at our firm, Rick Van Valkenburgh. Here are your hosts, Derek and Spencer.
Thank you, Chandler.
Thank you.
Yeah, so today we're welcoming on Rick. He's one of our tax partners here at Larson & Company, works out of our South Jordan office. So, Rick, welcome to the podcast. And how about you give us a little bit of background about yourself? Where'd you come from? Where are you going? Why are you here?
All right. Thanks, Derek. I guess to start with, I've known Derek since he was probably 3 years old. So
Yeah.
he's like a little brother to me. I married his older sister, so we've known each other for a long time, and we both really love his dad. He was a big influence in my life. I didn't think I was going to be a CPA. Never, when you're growing up and you tell people what you're going to be.
Yeah.
It was never like
Accountant isn't on there.
No,
It's on the list.
No, not as cool as.
Right now, that's what my son's saying, though. He's like, I'm going to be what you are, Dad.
Oh,
So that's always kind of fun.
that is. That's sweet.
Yeah.
That's funny. My kids have never said that, but we
But
have.
some of them are following in the footsteps, huh?
Yeah. So, I guess if the listeners are curious, Chandler, who introduced us in the podcast, is my son-in-law. So.
I'm not related whatsoever.
Yeah.
I also have a son here at Larson and a daughter, all working here. So that's really fun. When I started college, I thought I wanted to be an architect. It sounded a little more, I don't know, cool.
Yeah.
And did that program, started at the Salt Lake Community College and went up to the University of Utah and realized that that wasn't for me as much as I wanted it to be for me. It just wasn't my path. And so tried a semester of computer science, which was not for me also, but added a lot of value, I think, to the rest of my education.
Yeah.
And so I went over to the School of Business and started just trying to figure out what I wanted to do, ended up in accounting and really liked it. And, so officially switched over to the accounting major. And when I started recruiting with some of the bigger firms and looking at the possibility of moving out of state, Bradley, Derek's dad, reached out to me. And I think because we had a baby at that time, our daughter Allie, who's married to Chandler now, he didn't want us taking her out of state.
Yeah.
I think that was his motivation. So he offered me a job, and I accepted it, and that was probably one of the best decisions of my life. So Brad and I worked together for a little over 20 years, and I learned a lot from him. It was a small firm, just the two of us for the most part. We had a handful of other employees that did some of the bookkeeping and the administrative work, and some payroll stuff.
So you guys were doing tax work then?
Right.
Yeah.
Almost exclusively tax. We actually did do a couple compilations and reviews. So
Yeah.
we were peer reviewed and
Yeah.
maintained that through all the time I was there. But didn't do any audits or anything like that.
Yeah.
So, yeah, that's how I ended up in tax. And Brad retired in 2019, and we joined up with Larson in that year. And that's actually been a really good thing for us. It was a hard transition going from a small firm with the type of clients we had there, which we still have a lot of those clients that we love. But it's also changed, the type of clients that we have and the type of work that we do has evolved a little bit.
Yeah.
So
For sure.
I've really enjoyed being here at Larson & Company. I love the culture and I love the people. It's so fun working with, young people who are newer in the profession and have a lot of excitement,
Yeah.
believe it or not, about
Yeah.
learning and growing and, just doing a good job. So
Cool. Yeah. Well, we're glad you're here at Larson. I'm glad to be here at Larson too. I got to come over as a result of that move that Rick mentioned as well. That's why I'm here. But yeah, Larson's awesome. So
Yeah, that's awesome. And we're glad to have all three of you guys here, I guess.
that's right. And we're glad you're here too, Spencer.
yeah.
We're all glad.
Thanks. I got here with more ethical ways, I guess.
Whoa.
I'm just kidding. Anyways, but to go kind of to diving into the topic that we kind of wanted to talk about today, we wanted to talk about kind of year-end stuff. So what should taxpayers be thinking about as the year is coming to a close?
Yeah, it's a great question, and we get it a lot. And a lot of people want something, big. Like, tell me what is the thing I need to do right now? And it usually evolves around, I really want to buy this truck, and I'm hoping you're going to tell me that if I do that, I'm going to get a big tax break. And sometimes, in all honesty, sometimes it is a good tax break. But I think the number one thing I would say in that regard is, and this is so obvious, you almost hate to say it, but it needs to be, like, people need to be reminded, it's not a good investment to buy a truck for your business if your business doesn't actually need the truck. You're going to spend way more money, outlay way more cash than any potential tax savings you'll get from buying the truck.
Right.
Yes.
Right. Yeah. It's you're just like, let's say you're buying like a $70,000 truck.
Yeah.
You're buying a $70,000 truck to get, whatever let's say it falls in the tax rate of like 12%. And so you'll like save that percentage or whatever.
Yeah.
And so it's just way outpacing the benefit of actually like the tax benefit that you're going to get.
Yep.
Yeah. So to that point though, let's say you own a construction company and you need a new truck and it happens to be $70,000, and it's a work truck, and it's 100% business use, then you could potentially write that all off in the year of acquisition. So I've had a client before that acquired a truck on December 31st, financed it, so hadn't really paid anything for it yet, but got
Potentially no money down.
no, right. And whether it's through bonus depreciation or through Section 179, he had a $60,000, $70,000 deduction with no cash out of pocket because he took possession of that truck on December 31st and it was 100% business use.
Yeah.
And in that case, it worked for him because he actually needed the truck. But let's say in another scenario, it's still qualified, truck. He buys $70,000 truck for the deduction because he thought he needed that for taxes. Well, eventually, trucks are heavy. They wear through tires. They need a lot of fuel and maintenance. The cost of owning that truck, where maybe he could have done something different, might outstrip any of the tax benefit that he received in that first year. So you gotta balance it. It's not always. Sometimes it's the knee-jerk reaction. I need to do something because it's going to affect me now, without really thinking much about what that might do to you in the future.
Yeah.
Yeah.
So,
Well, I think that's a big proponent or advocate for tax planning just in general.
Yeah.
Of what not only the rest of, so we're coming to the close of 2024, what the rest of 2024 is going to look like, but maybe what's 2025 going to look like as well.
right.
And so kind of what about that sort of issue where maybe you're kind of getting close to the year end and you want to see, what does the rest of 2024 look like?
Yeah, and that's a great point. If you expect, so basic tax planning rules tell you that you should defer revenue if you can. And when I say these things, I want to make sure we're clear that this is all in legitimate ways, legal ways.
Correct.
Yes.
Defer revenue and accelerate expenses. Those are the two main tax planning rules, right?
Yep.
Well, if if something is coming down the line in 2025 where your tax bracket is going to be higher in 2025, maybe you don't want to accelerate expenses or defer revenue. So it's a good point you made, Spencer. Don't just look at today. Consider what's happening tomorrow, and if these decisions are the right decisions. Sometimes accelerating depreciation isn't the right decision because you might benefit more from it in the future. The general rule of thumb, though, is if you save a tax dollar today, it's better for you because of the time value of money, potential for rate increases or whatever the case may be.
Mm-hmm.
Yeah.
So, and that's what most people try to do. They want to save money today. So, some of the basic things you look at. Number one, the easy things. Let's just hit those real quick. Are you contributing to your retirement account? There's a debate we can definitely discuss. Is a tax deferred retirement account the way to go, or is it better to do like an after tax Roth type account? And there's definitely a strong argument for doing Roth type retirement contributions. If somebody has a qualified health insurance plan for a health savings account, then that's the only thing that I know of where you can contribute tax-free, it grows tax-free, and you never pay tax on the distributions as long as you take them out for qualified retirement account, qualified medical expenses.
Yeah.
Yeah.
Yeah, that's an awesome tool.
Yeah, so if somebody has an HSA that they haven't maxed out, something that maybe people don't realize is, it's because it's done through payroll. They don't know that you can, outside of payroll, make additional contributions to your HSA account if you haven't maxed it out. And there are limits if you're, just a single coverage
Versus like a family coverage.
versus a family
Yeah.
coverage. The limits
I mean,
change.
What's the maximum benefit you can get on that? Something like $8,000 in a year is like your maximum contribution.
I think
Right.
it's
It's over.
7,500.
There's a few different limitations for sure. So,
Yeah.
If
but
you're over 50, then you get a little extra amount. If both spouses are over 50,
Yeah,
and it's
so-
a family plan, there's
so
extra.
you're in that range, right? Though, so still the biggest deduction you could theoretically get is somewhere around $8,000, right?
Yeah, 8 or 9.
Yeah, it's 4,150 is the maximum for a single individual, and then 8,300 for a family in
Yeah.
2024. And they index those for inflation, so they change them every year.
And then if you're over 55, you can do additional catch-up contributions
Right.
to that. So,
Yep.
which is that's a lot.
Yeah, if you're in the 22% bracket, and I mean that can make a difference.
Yeah.
Since we're talking about insurance, let's just talk a little bit about the Affordable Care Act.
Sometimes referred to as Obamacare, right?
Obamacare, yeah.
People might know it as that.
Yep. So, the way Obamacare works is at the beginning of the year when you apply for insurance coverage, you have to estimate your income for the year. And in doing that, there's a determination made on whether or not you qualify for what's called an advanced premium tax credit, which basically means that the federal government is going to help subsidize the insurance cost. And it depends on what your income is compared to an index of what they consider the poverty level for an area. And so a lot of people, I guess we should say, you only qualify for this subsidy if you don't have an employer that already offers you an insurance plan. If your employer offers you an insurance plan, you can't participate in this. But a lot of small businesses or self-employed individuals will take advantage of the Obamacare plans. It's sometimes tricky when you apply for the plan to correctly estimate your income. And so at the end of the year, there's a form that's attached to your tax return that reconciles what you received, if you received any of the advanced premium tax credit. It reconciles it against what you should have received. And if there's if you received more than you should have, then you have to pay some of that back.
Mm-hmm.
What often happens is somebody's income will be higher than the threshold that's allowed to receive any premium tax credit at all, whether it's advanced or at the end of the year. And so the advanced premium tax credit has to be repaid. Well, sometimes it's close, like the threshold is close and it's about 400% of the poverty level. It depends on where you're at, but let's say in Utah, if you make less than $120,000 a year, something like that, then you probably qualify for some premium tax credit. If you have an opportunity at the end of the year to make a retirement contribution, or to maybe inside of your business purchase an asset that will help lower your taxable income below the threshold that allows you to qualify for the premium tax credit.
Yeah, then there could be a larger benefit there, huh?
Exactly. We've had a number of instances where, we're preparing the tax return and maybe it's on extension, and so we don't actually get the information until July. And we find out that they were close, but they were over the threshold, and so they have to pay back the entire premium tax credit. And we've seen people, really get hammered hard on that. So if there would have been a little bit of opportunity to address that before the end of the year, we could have potentially saved them, thousands of dollars in premium tax credit.
Yeah.
Yeah.
So I'll mention a couple other things. Sometimes you might know that if you have stock losses, you're limited on how much of that you can utilize in a year.
Mm-hmm.
Some people have accumulated stock losses that have been rolling from year to year, or maybe it's not stock, it's a loss on an investment property or something that they had in the past. And then
So you can take up to $3,000 a year as a deduction, right?
unless you have other capital gains,
Yeah.
and then you can fully utilize whatever capital losses you have against those capital gains. And so in a good year, maybe you meet with your financial planner and you say, hey, I've got these losses. Is there something we want to move and harvest some of the gains so we can offset these losses? Or maybe you see something in the future coming, like you're planning on selling a real estate investment or something in a future year, and so you want to harvest losses in your stock portfolio, whether it's a current year offset to a gain from a sale of investment real estate. So I guess the point is kind of looking at your capital assets and seeing if there's an opportunity
Yeah.
to make some changes that will also give you some tax benefits.
Okay.
Yeah, that's a good point. When I was working at a prior firm, they had sold their business and they were getting like $50 million in like capital gains. And so they were just trying to figure out what to do. And we looked at with their financial advisor, we looked at their portfolio and saw that they were in a couple big loss positions on some of their stocks. And we're like, well, you could just harvest some of those losses in your portfolio to decrease that $50 million gain that you just got from selling the business.
And
Yeah.
so it helped.
Yeah. So it helped.
Yeah, when we say harvest a loss, what are we saying there?
Well, in your stock portfolio, as the prices fluctuate, you don't have to, as long as you're holding the stock, it has no impact on your taxes, other than if you receive interest and dividends, and you'll recognize the income from the interest and dividends along the way. The moment you trade that stock for another stock, or if you liquidate it and for cash or whatever, it generates a gain or a loss based on what you sold it for compared to what you bought it for.
Okay.
In the meantime, though, you might have stock that you bought, at $100 a share, and currently it's sitting at $50 a share, and so you've got a pretty big loss sitting in there. But you haven't sold it because you're hoping it'll come back up. Well, maybe there's a time where you decide, I don't know if this is ever going to recover or not fast enough for me, so I'm going to recognize those losses now by selling the stock.
Got it.
Yeah.
Okay, that makes
It's
sense.
harvesting.
Yeah, that's
Yeah,
that's harvesting a loss. Got it.
Yeah.
Cool.
Yeah, I've heard when you're a hunter, you don't kill an elk, you harvest it.
Yeah.
One of the I think the biggest opportunities right now for small business owners pass through entities, S corporations, partnerships, LLCs that file as either an S corp or a partnership, is an opportunity to pay your state taxes at the entity level, rather than at the individual level. So just a little background. Whether you are itemizing your deductions, which means you have mortgage interest state and local taxes, charitable donations, maybe some medical expenses. If these types of expenses are greater than the standard deduction, whether you're single or married or maybe head of household, I think for 2024, the standard deduction for a married couple is somewhere around $30,000, which is pretty significant.
Yeah.
So if you have expenses of that nature that are in excess of 30,000, then you itemize, right? You get to deduct either the higher of your itemized deductions or standard deduction. Well, in either case, the amount of deduction you can have for state and local taxes is capped at $10,000. And that's part of the Tax Cuts and Jobs Act. So it's been here for 7 or 8 years now. An individual who has ownership in a pass-through entity can elect to pay state taxes at the entity level based on the income generated by that entity and deduct it fully against their federal taxable income without any limitation. Maybe you're a small business owner that doesn't itemize because your itemized deductions aren't greater than the standard deduction. It works for you still because you're getting a deduction for state taxes in addition to your standard deduction on your personal return.
Yeah.
And so something that it's potentially a great opportunity. It depends on the state you're in. I don't remember how many states have enacted laws that allow you to do pass-through entity tax at the state level, but I think it's a lot. It's like maybe 30 or something states.
Yep. It is a lot.
I would say it's most.
And then you back out those states that maybe don't have income tax,
Right.
and so then you're getting so most of the states
As of
have
May,
something.
so according to the AICPA, as of May 14th, it's 36 states
Okay.
Yeah.
that allow.
And then there's something like 10 or 15 states that don't have an income tax.
So you're basically
9 states with no owner level personal income tax. That's
Okay.
like Alaska, Florida, and then 4 states with an owner level personal income tax on pass-through entity income that have not yet proposed or enacted pass-through entity taxes. So
Yeah.
so most.
So if you live in those states, consider moving.
yeah,
That's right.
It's not Utah.
Well, one other thing to think about too is, in some of these pass-through entities, you might be operating in multiple states, and so
Right.
you can make multiple elections.
you can make multiple elections, right? If you would theoretically have income sourced to Utah and California, you might pay PT in both of those,
Yeah.
Yeah.
right?
Yeah. So the way it works, though, is you get a deduction against your federal income tax at the entity level, and then the payment that you made toward the state goes. It flows through on a K-1 to the individual owners of that entity, and it's a credit against your state taxes due. So you're basically prepaying your state tax at the entity level.
Yep.
It gives you
You get that deduction.
the deduction for federal tax. So potentially a really good planning opportunity. And so we do a lot of that type of work at the end of the
And
year.
those payments typically need to be made by the end of the year, right?
Yeah.
So
Yeah.
it's not something we can do in February,
At filing time.
right? Or when you're filing the return, you kind of
Right.
got to do this. You got to plan ahead.
That's exactly right. Because tax returns are generally filed on a cash basis for an individual.
Yeah.
And since this is tied to an individual,
It's a credit on the individual level.
right. So if you did happen to make that pass-through entity tax payment in February, it would count toward the year that
That you made the payment
you
in.
made the payment.
So you're not going to lose the benefit. It's
No.
just you're not going to pick it up right in
If
this.
you were wanting it in 2023.
Yeah. Got it.
But there are some rules around this. It can't just be the Wild West, where you pay whatever you want, get a huge deduction against your federal taxes.
Right.
There has to be merit in the payment. And so because it is a federal deduction, there needs to be some methodology of determining that it's a legitimate deduction. And so the approach that we take is usually, November, December, you have a pretty good feel for how the year is going. And we can project out the last few weeks of the year if we need to. But we'll determine what we think your taxable income is before the end of the year and come up with what the state tax amount would be on that taxable income. And that's the amount you're allowed to deduct. So it's also important to understand that if you overpay the state tax, maybe you have losses from other businesses, or for whatever reason your state tax is lower than the prepayment that you make. States treat that differently. In Utah, for example, it's called a non-refundable credit when you make that tax payment, and so you won't get a refund for overpaying the tax. It sits on the shelf, so to speak, until you can use it, but it'll only carry forward for 5 years. So if you way overpay and you're never able to utilize it, you can actually
Lose it.
entirely. Yeah. So you need to be careful. You need to do it right. But it's definitely a good opportunity to reduce some taxes. And it's one of these things where, it oftentimes results in thousands of dollars in federal taxes saved. So definitely something to consider.
Yeah, that's awesome. I think that covers a ton of the topics that we wanted to talk about today. Just kind of wrapping up, maybe considering asset purchases or retirement contributions or those HSA contributions, looking at your capital gains for the year, and maybe you need to harvest some of those losses somewhere else, projecting your taxable income, not just for the current year, but maybe looking a year ahead to kind of see what the income is going to be like for the next year, thinking of pass-through entity payments and estimates. Anything else that you kind of wanted to talk about, Rick?
Of course, if you're married, you have to take if both spouses are working and, both are bringing in taxable income or maybe losses. Sometimes we have clients that they're married but they don't always think as married people, and
Right.
and so they're looking at opportunities to reduce taxable income maybe in their S corporation, but their wife already has losses or something, right? And they file a joint return. So it's one of those things again where it sounds obvious and you don't really need to say it, but keep in mind all your sources of income and take it as a holistic approach. So when we do tax planning for pass-through entities, it's never enough to do it for the entity. We always need to know who the owners are and how it's going to impact the owners.
Yeah. Great advice, Rick. Thank you so much.
Yeah. Thanks a bunch for coming on and teaching us about some of this stuff, Rick.
You bet. It's fun to be here. Thanks, guys.
Yeah, of course. Thanks, everyone, for listening.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.